you've got this great saying, which you always use, that whoever has a direct method cash flow is the most dangerous person at the company. And clearly, through all the companies you've been at as a PE investor now, and at this stage in your career, and even before working with PE firms, right? Maybe you can share a little bit of background, just quickly summarize, just for those that might not be as familiar, the difference between direct method and indirect method, but then also dive into why you like to say that, because it's a really awesome expression that stuck with me since the first moment I heard you say it.
Sure, absolutely. And so I think an interesting lens to bring to that question in terms of the answer, Carlos, is to talk about just the broad objectives of a modern kind of 2021 CFO, right? And so in the interest of time, I can boil those down to really two buckets. The first, I would say, is putting the business in a position for success. And it's that simple, right? The CFO's job is to set everyone, his own team or her own team, the other peers on the operational leadership team, and the CEO up for success. There's a myriad of ways in which we can do that, and we can get into that later. I would compare it, to use an analogy, to an offensive or defensive coordinator. The Super Bowl just went down, right, in terms of what those folks do, right, to set the team up in practice and in strategy for success. Or if you're not into sports, I often will compare it to, the NASA Johnson Space Center in Houston, right? You've got all these astronauts and folks out there that you have to provide data and research and training to, both before a mission and during the mission to set them up for success. So those are kind of glorious analogies for a CFO, but that's how I think of it. And critical to that, let me get to the second one first. This is a little less exciting probably for most folks on the Zoom, but the reality is, we have to set the business up for a return on investment to shareholders. So those are the two things: set the team up for success and provide a return on investment to shareholders. And the return on investment, there's metrics like money on invested capital and internal rate of return, but fundamentally they invest in the business as investors to produce a return, and it's one of the responsibilities of a CFO to ensure that. So Carlos, now pivoting back to your question about cash forecasting and cash, and why I call the owner of a cash forecast the most dangerous person in the business. Well, critical to both setting the business up for success and producing an ROI is having cash. You hear the phrase, everybody's sick of it, cash is king, but I think this past year and this pandemic were a stark reminder of just how true that is, right? When things go sideways, immediately everyone focuses on cash. And so why do I say the most dangerous person in the business is the person who owns the cash forecast? Well, let's step back a minute. There's an indirect method cash flow and cash flow forecast, which is part of your three financial statements. You have your balance sheet, your income statement, and between the two, I often call it squeezing into it, right? You produce the statement of cash flows. And that becomes a forecast when you do that for your planned financial statements, right? But an indirect method cash flow forecast, while it's very useful from a very high level to understand the operational, financial, and investing cash flows, there's not much you can take and go action out of that. Very often it raises the right questions, but you then need to go dig into things like historical banking data to understand the minutia. So what a direct method cash flow forecast is unwinding very often your income statement, but certainly your financial plans into cash. And so you may look out 12 months. The classic one is 13-week cash flow forecast, which is never enough anymore. But you're using things like projections. You're using things in the short term like your accounts receivable aging, and you're unwinding that all to cash. AP aging, unwinding it to cash. Taking a look at your payroll calendar, unwinding it to cash. So it's a very complex, usually Excel model. And Brian and Molly can certainly support me in saying it's complicated. But whoever owns that knows with a high degree of certainty and accuracy every dollar that's leaving the company and when it's leaving and why, and every dollar that's coming in from whom and when you expect it. And what that ends up being is a really powerful tool for improvement in the business and insights for the executives on how to run the business. And so I say whoever owns it is the most dangerous person in the business, because if things start to unfold as not expected, they know exactly where to go. Maybe one week it's the leader of customer success, maybe the next week it's the leader of sales, but they're showing some variance to that leader and saying, help me understand why this vendor spend went out when we expected it to go out maybe a month from now. Or going to sales and saying, hey, we're getting paid early on a couple of these invoices. Is there anything weird happening that I don't know about? Are we offering early pay discounts that are kind of outside of finance's purview? And so that's a lot, Carlos, and I could probably talk for an hour on direct method cash flow forecasting, but hopefully that was helpful.